Thank you very much. You're saying you're joining us from Kisii. Thank you, and it's good to have you back again. Just let us know what's one of your expectations that you hope now today to get from the session where we'll be looking at using financial statements. We'd love to hear from you. Otherwise, thank you very much for joining us. And the rest, just keep introducing yourselves. It's one of the ways that you're going to grow, learn, and connect together through this session. Elizabeth from Mombasa, thank you very much. Okay. Yeah, you can also feel free to tell one or two things that you've learned so far from the previous two sessions that we've run together on business records and indeed understanding financial statements. So today is an extension of what we had started, and we hope you'll be able to really get as much as you can from this session. Magoma Geke, you're joining us from Nairobi. Thank you very much. Okay, and I see others keep joining us. We are really glad that you've been able to take some time off to join this session today. So I'm going to stay on mute again and give you a chance to keep introducing yourselves, writing your expectations, and just getting to know each other. Thank you, Alex from Nanyuki, Fred from Nairobi, and Kuto, you're asking for the previous recording. We will share that through to your email. Okay. All right. All right, so thank you very much, Magoma, there. I can see your expectations. You want to keep business records and statements as simple as possible. Thank you very much for that. Okay, so I'd like to welcome those who are joining us. You're still on time. We'll be starting in 8 minutes, just giving you time to log in, and we're just sharing our names, getting to know where we're logging in from, and at least one expectations that we look forward to get out of this training today. And today we'll be looking at using financial statements. So far we've done two. We've done business records, how important it is to our businesses and the different uses, the different business records that we have. And we've also looked at understanding financial statements. So really today is an extension of what we started. And we hope that you're going to really get more from this. Our trainer for the day, Esther, is ready. And our colleagues from CoopBank side who are also ready. I see Anthony and Peter, they've already joined in. So we are really looking forward for a good session. You'll notice that your microphone has been muted and video turned off, just to ensure that we have a smooth flow of this training today. So thank you very much. I'm still gonna stay on mute for a couple of minutes. I will come right back on to just ensure that I read all your comments as far as expectation, your name and where you're logging us in from is concerned. I see Mbatia from Mombasa. You're looking forward for the session. Thank you very much and welcome. Nicholas from Nairobi. Thank you very much, guys, for sending in your comments and letting us know where you're logging in from. Thank you very much. Okay, Benedict from Kakamega. Thank you very much. And I hope you're excited as we are for yet another exciting session. Today is the third one. We are looking at using financial statements. So be ready, get your pens and paper, your iPad, anything that you want to ensure that you don't miss anything. And it is our hope that no one is going to be left behind as far as this session today is concerned. Okay. Paulo Teo from Migori, thank you very much. So I'm gonna stay right on mute and then I'll come right back on to read your expectations. And please stay tuned. All right. Benedict, you're saying that you're very excited and it is your hope that this training is going to help you as far as financial statements are concerned. Thank you very much for that. Okay, Rafael, thank you very much for your comments there. And you're logging in from Nairobi. And your expectation for the session today is that you want to understand how big data can be leveraged to analyze and better understand financial statements faster. Thank you very much for that. Okay. So let's see. Elizabeth from Mombasa, you're saying your expectation for today's session is to understand how to analyze financial statements. Thank you, Elizabeth, for that. Okay, let's see. So we are 3 minutes away. just to welcome those who are joining us. You're still on time. We're just getting to know each other, getting to understand our expectation for this session today, and just to understand where we're logging in from. Francisca, I can see your hand is up. Kindly use the chat box to communicate to us, as we have muted all the microphones. Thank you. Ezekiel, thank you very much. You're saying that your expectation for the session today is you want to learn more about cash inflows and outflows when it comes to balancing our financial statements. So thank you very much for that. I see we're at the top of the hour. We are going to give 3 more minutes to help and see whether others are going to join in. Just give them space to join in, and then we will start. So we'll give them 3 more minutes, and then we shall start. I see Esther is ready. Okay. Otherwise, thank you very much for joining early and putting in your comments, your expectations. We've learned what it is that you're expecting to get out of this. And we are really looking forward for an exciting session. So let's give them 2 more minutes and then we shall begin. Okay, Joshua and Jua, thank you very much for your comments there. You expect to learn how to maintain cash flow. All right. I can see others are still joining. Okay, so I'm going to stay mute for the next 2 minutes, and then I'll come back and start the session. So good morning, everyone, and thank you very much for joining us. My name is Jimmy Chakacha. I work for the International Finance Corporation as an SME banking consultant. I support this project with CoBank and other projects on banking on women and SME banking. Today, I'm honored to be your moderator. I'll be supporting Esther and our colleagues from the CoBank side. IFC is a short form for the International Finance Corporation, for those who don't know. It is the private sector arm of the World Bank Group. And we work with financial institutions, for example, now in our case here with Cooperative Bank to build the capacity of SMEs. And today we are in our third module on using financial statement. We've already done 2 previously, which have been very detailed, and we've really enjoyed your participation. We've done business records and understanding financial statements. So today we are ready to dive in and really get an understanding and enrich our insights on using financial statements. We have muted your microphones and your videos turned off to ensure that we have a very good communication and better understanding of each other. We'll be recording this session, and just to ensure that none is left behind. And as far as enjoying this session is concerned, we are going to use example, we are going to have polls, and we'll be using the chat box to communicate all through. And should you have any questions, please put it on the Q&A session. So without much ado, I'd like to hand it over to Peter from the CoBank side to make introductory remarks. And then Peter will hand it over to Esther, and then we shall begin. Peter, if you can hear me, over to you, and thank you very much.
Thank you. Thank you so much, Jimmy, for that welcome and introduction. And thank you so much, our customers, for joining this webinar. And before we start, and as a tradition for the bank, we want to start with a word of prayer. Lois Karanja from Diaspora Banking can go ahead and pray for us.
Thank you, Peter, and thank you, our customers, for joining. Let us pray to start our session today. Dear Lord, we thank you for the grace that you have granted each of our customers today to be present in this meeting. I pray for the content that is going to be shared, that, Lord, it is going to bless them even as they run their businesses. This we pray, trusting and believing. Amen. Back to you, Peter.
Amen, 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 Lois. And thank you so much. Lois works with us in Diaspora Banking. She supports our relatives who are in other countries, and she's a relationship manager. Thank you so much. Our customers, again, a very warm welcome to us in this session. We are glad that you've joined and you've met another time. This is the third part of the webinar in this series that we have started. It's part of the global and the biggest sessions that we have to support our MSMEs in terms of the financial and non-financial services. And so today we are glad that you have come again, and we're going to have a very good session. And as is just welcome us in this session to participate. For the trainers of the day, we also want to take this opportunity to welcome welcome you. And also for the staff members who are also logged in from CoBank, we take this opportunity to welcome all of you. IFC team, many thanks for supporting us and joining this session. We also take this opportunity to welcome all of you. As I depicted, this is a part of the commitment the bank have to ensure that we continue to support our MSMEs, all our business customers, all our entrepreneurs, to continue doing their businesses, even at this time where we are in COVID. And we'll continue to support you with information that is necessary and it's important for you to grow your business. And again, we also continue to support you with the financial solutions that the bank have and they have developed to ensure that we support you. And so today we are glad because we're going to have a very good session. We have seen you participate before through the chat box. And in this session, we also believe that you're also going to participate in our, in the chat box to ask questions, give feedback, and share comments. And we'll ensure that we'll also respond to the queries that you have during this session. So with us, we have 2 trainers. We have Esther Masharia, who is a lead trainer in this capacity building program working with IFC, and she'll be taking us through this session on using financial statement. And I'm sure we'll be able to interact with her further. We also have Anthony Kinyo-Angeshi, who is our head of SME in the bank, and he'll also come to say what are some of the solutions that the bank have also developed and lined for you as our customers to continue to support you. And so I just want to welcome us to participate fully. Have a pen and a paper, please make sure that you learn something. And above all, we also want to ensure that you are going to use the tips and the insights that we're going to have to ensure that you implement into your business. Our plan and our prayer and our objective is to ensure that your businesses continue to grow and they continue to thrive. So without further ado, I want to invite Esther to take it up and proceed with the presentation. Over to you, Esther.
Good morning. It's great to have you here. I welcome you to this course. This is our third course in a series of 10 courses. And today we are going to be looking at using financial statements. We have had 2 other courses. We started off with business records. Then we went to the course on understanding financial statement. So in this course, we are going to focus on how to use financial statements. We are offering you these skills because we know that you have challenges in using financial statement. And this course is going to equip you with useful pieces of information in financial statement that will help you to solve questions and or concerns that you have in running your business. So financial statements, they hold very many hidden secrets about the health of your business, but you have to know how to read those secrets that they hold. Some business owners sometimes usually wonder why they are asked for financial statements by prospective lenders. And it is because they use the information that they discover, the hidden truths that are inside there. They're going to be able to know how your business is running. And this course is going to help you to discover the truths behind the numbers in your financial statement and how to address them. So you should not be taken by surprise when your lender is asking for this. So at the end of this course, we're also going to tell you more about other training courses that we are offering. Like I've told you, it's in a series of many. And a good place that we need to start is, we need to identify some of the specific challenges that you face when using financial statement. And in this, we are going to go to our poll. Let's take 2 minutes and share in this poll. What challenges do you face in using financial statements? 2 minutes. Let's look at that. Let's participate.
Thanks, Esther. So the poll is up. I will be sharing the results in the next 30 seconds. I see voting is going on there.
Yeah.
Okay, and I bring it to an end. Okay, so allow me to share the results.
Yeah.
What challenges do you face in using financial statements? And the majority here, that is 40%, are saying, I don't prepare financial statements often. 38% are saying, I don't know how to use them. And then 4%, we are saying, I don't see the value of using my financial statements. And then that is the work of my bookkeeper. That's 15% of us are saying. And lastly, I can't make sense of them. So that's how it looks. Esther, over to you.
Thank you. Thank you very much. And thank you for participating, and I thank you for your honesty. So this course is going to build skills in using financial statement. And you benefit from this course in the following ways. It will help you to monitor your business performance regularly. It will arm you with basic financial analysis skills that are going to help you in analyzing your business finances regularly so that you're able to monitor performance. You'll be able to identify causes of business non-performance. Why is my business not performing? You also be able to assess your business profitability. And this is where you come now to start realizing the differences that come in between profit and profitability. You will also be able to engage better with prospective leaders. Once you understand once you're able to know how to use the financial statement, even when you're speaking to a leader, you now be in a more informed space. Then you'll be able to assess, they'll help you to assess the ability to pay debts on time so that you're not caught by surprise. And also you'll be able to make better financial decisions. One thing about numbers, they tell a story. Numbers tell a story and numbers don't lie. So you're going to gain very useful insights from analyzing your financial statement, and they're going to help you make better informed decisions. And now that you have seen the benefits of this course, we are going to look at the learning objectives. In our course today, you'll be able to, after you go through this course, you'll be able to explain the importance of financial analysis. You also be able to perform comparative analysis and also perform ratio analysis. When we started off, we looked at the profit and loss statement and the balance sheet. And we learned last week about understanding the financial statement. Then we are going to introduce in this course the XYZ balance sheet that even we had last time. And we are going to use it to perform some financial analysis. Then as we go to comparative analysis, we are going to help you discover useful information about your business. We are going to learn different bases that you can use in comparative analysis and also be able to tell you what that is all about. And then in the last lesson, which is in performing the ratio analysis, you are going to discover that there are three main categories of financial ratios that are used: the profitability ratios, the liquidity ratios, and the debt ratios. And for each category, we are going to identify the ratios to use that are very useful. We are going to explain the importance of the ratio. And then also beyond that, we are going to tell you the meaning of each of the ratios. You'll be able to apply each of the ratios that we are going to learn using the XYZ statement that we are going to have. And then beyond that, we are going to conclude the lesson by highlighting the limitations of financial ratio analysis, because for this also there are limitations. So we are going to be performing multiple activities. So I want you to prepare yourself with a pen and a paper. And if you have a calculator, also you can have that with you. So we are going to go through this together. We'll learn with you. And in each and every step, by the time you get out of here, you'll be an expert in that area. Now that we have looked at the kind of path we are going to go through as we learn, let us agree on some ground rules. First and foremost, participate. The more you participate, the more you learn from this course. Then respect each other. We respect all views and opinions expressed in this course, so do not be afraid. And we are all here to learn, even me as I sit with you. Then we, like Jimmy had communicated, we have muted your microphones so that you can be able to hear me clearly without any kind of background noise. If you want to participate in any way, just go to the chat and you put your comments there. As we go along, in case a question arises, put it in the Q&A. The Q&A section, you put it there. We will answer your questions as we go along. So do not hold on your question to the very end. put it in the Q&A, and also communicate with us on chat. We have a number of people who'll be interacting on the chat platform. So to move on, let us test our memory about what we learned in understanding financial statement. And in this, we are going to go to a poll where we have some questions. Jimmy is going to share with us this poll. We'll take 2 minutes. Let's go through it and answer some questions on the financial statements. So Jimmy, over to you for the poll.
Okay. Thank you very much, Esther. The poll is up. And we have 3 questions. Statement summaries that summarizes the trading activities of a business over a period of time.
Yes, so we have got which statement summarizes trading activities of a business, the period of time. Then we have question number 2. Jimmy, over to you.
Yeah, so statement number 2 saying statement showing the assets, liabilities, and capital of a business. Okay. And then the last question is we are asking what statement reports the inflow and outflows of cash during an accounting period. Okay, thank you. I see, guys, you're putting in your polls there. Okay, so we are 20 seconds away, and then I'll bring this one to a close, I'll share the results, and then we proceed. Okay. So there we go. Let's see how we've done. First question, let me share with you, Sarah. Statement summarizing the trading activities of a business over a period of time. 82% of us are saying it's a profit and loss statement. 5% are saying balance sheet. And lastly, 13 are saying cash flow statement. Question number 2, statement showing assets, liabilities, and capital of a business. 13% of us have said it's a profit and loss. 79%, which is the majority, have said it's a balance sheet. And then lastly, 9% of us had said it's a cash flow statement. Our last question, statement that reports the inflow and outflow of cash during an accounting period. The majority of us, that is 84%, have said cash flow statement. 11% of us have said it's a balance sheet. And then 5% of us have said it's a profit and loss account. So that's how it looks. Esther, over to you.
Thank you, Jimmy, for taking us through. And great, I can see excellent memory work. And to be able to be on the same page, let us recap on the key financial statement. So the first statement we have is the profit and loss account. And it usually focuses on the analysis. It usually summarizes the trading activities of your business over a period of time. So for question 1, the answer is profit and loss account. Then we go to the balance sheet, and it assesses the financial strength of your business. It shows the assets and liabilities and owner's equity, or what we call capital. Then the cash flow statement. It reports the inflows and outflows of cash during an accounting period. So for the purpose of this course, we are going to focus on the profit and loss statement and the balance sheet. This is going to be our focus of the analysis, and that is what we are going to be looking at. Now, to start us off, what do you remember about the profit and loss statement? And let's go to chat here, we start communicating. So what are the 3 profit elements in the profit and loss statement? The 3 profit elements. Let's share on chat. Which are the 3 profit elements that we have in the profit and loss statement? Let's share on chat, and Jimmy will take us through. He'll read the answers as they come through.
Right, let's see what we have. Rafael, thank you for your question. Okay, so there's one here saying gross profit, net profit, income, earnings, expenses. Wow, thank you very much. So I'll hand it back over to you, Esther. The responses are coming in here: income, gross profit, capital,
Mhm.
cash in minus outflows. All right.
Okay.
So over to you, Esther, as you can hear.
Wow. Thank you for participating, and that is very good. I hear the wonderful responses. And when you're looking at the 3 profit elements in a profit and loss statement, we usually have 3 profits. We have got the gross profit, the operating profit, and the net profit. And now we are going to go to the statement where we are going to be looking at this. We have this statement, which is the XYZ company, and we have their profit and loss statement, which we have over here. We have the gross profit, which we usually get after deducting all the direct costs. Then we get the operating profit. We get it after deducting the operating expenses from the gross profit. And eventually we have the net profit, which we usually get after deducting the non-operating costs. The non-operating cost from the operating profit, we get the net profit. So in your profit and loss statement, we usually have 3 elements of profit: the gross profit, the operating profit, and the net profit. And we are going to really focus on that as we do the analysis of this statement. This is the statement that we are going to use in our example. Now, I want us to shift our focus to the balance sheet and see, what do you recall? And in this case, what are the 3 components of the balance sheet equation? What are the 3 components of the balance sheet equation? Let's share on chart. We looked at it last week. So let's see, which are the 3 components of the balance sheet equation? What do you find in that balance sheet?
Okay, so assets and liability, that's Mary, thank you for that. We have assets, liability, and capital, thank you. Assets, liability, and capital. Christine says assets. Jonathan says assets, liability, and capital. So there you go, Esther, as you can hear.
Thank you, great responses. And in this one, 100%. So we have the assets, the liabilities, and the capital, or what we call the owner's equity. And now let's look at the XYZ balance sheet. And we have it here, where we have the total assets that are made up of the current assets and the fixed assets. Then we have the liabilities that will be made up of the current liabilities plus the long-term liabilities. And eventually we have the owner's equity. As we are looking at the balance sheet equation, the total assets is usually equals to total liabilities plus the owner's equity. And that is what leads to a balanced balance sheet. So that is what we have with us. And this statement, we are going to be using it in our analysis today. So have you ever stopped to ask yourself this question? What is the importance of financial statement analysis? And we are going now to look at the importance of financial statement analysis. And as you recall in our previous course, the profit and loss statement, it will help you to track the progress of your business. Then the balance sheet helps you to track the health of your business at a particular point in time. And the cash flow statement will help you track the cash health of your business. How much cash do I have? So what is there is that it is one thing for you as a business person to monitor the changes in your business. But what is more important is your ability to explain the changes. Why do I have these changes? Financial analysis is important because it's going to help you to explain the changes in the financial performance of your business. It is what answers the question, why? Why that number? Why that performance? So we are going to see why we need to analyze the financial statement. And so, and in this particular lesson, this is what we are really going to be looking at, this second lesson on why we analyze the financial statement, the importance. So imagine for a moment that someone asked you to lend them some money. A look at their financial statement will help you decide. And that is why when you go to the bank at all times, the moment you ask to be lent money, the first thing they will ask you are the financial statement. So I want you to look at this statement for 2 minutes. Someone has asked you, has come to borrow money from you, and they give you this financial statement, okay? Based on the financial statement, would you lend them money? Share with us on chat. Look at the statement. Would you lend them the money? And if you'd lend them the money, why would you? And if not, why would you not lend them money? Look at it. Let's study it together. You're going to be doing a lot of activities together for you to understand the course. 2 minutes. And Jimmy, you can give us the answers as they come through. Would you lend the owner of these financial statements money?
Okay. Let's see whether we are going to lend. Okay, there's a no there from Jennifer.
And why?
Says,
Give us
yes,
the
he can
reasons.
lend because he makes profit. Lydia
Mhm.
says, yes, I would lend. All right, so let's hear. I would lend them because they are showing increase in net profit. That's Elizabeth. Thank you for that. Their sales are increasing. That's Intabo, so they would lend.
Mhm.
Okay, Elizabeth says, yes, they would lend because there's some improvement from last year. Okay.
Wow.
Jennifer says, because the liability are far too many, so they wouldn't lend. The business is increasing activity, okay, so they would lend. So there are mixed answers here. There are those who are saying they would lend, but those who are saying yes are the majority.
Okay.
There are few no's. Okay, so over to you, Esther.
Thank you, Jimmy, for taking us through. And I thank you for also your responses. You see, for every list, for you either deciding to lend or not to lend, you had a reason because of looking at financial statements. So what you need to realize is that businesses make decisions every day about what to do with money. Even if you're not investing in your own company, you're investing in somebody else, you are not investing in somebody else's company, you're investing in your own company. There are decisions to make about where to invest your money or where to spend the money. So financial statement analysis are going to help you to make better decisions. And with that, let's look at the definition of financial statement analysis. So when you're looking at financial statement analysis, it's a process that examines the past and current financial data. And it is for the purpose of evaluating performance and estimating the future risks. The moment we talk about a process, it is implying that the analysis is not a one-time event. It is continuous, it's a continuous activity of monitoring the performance of your business. So you have to keep doing it. When you're talking about examining, we look at the trend of the past performance as a possible indicator of future performance. Then we are looking at financial data. And if you remember from our business records, is that the financial data, it's put in the financial statement in understanding business, the financial statement, and it is usually a summary of all the detailed financial information that we get from business records. So we are looking at financial data in this case. Then evaluating performance, the financial analysis, it is used by investors, it will be used by creditors, the security analysts that you have, bank lending officers who are always asking you for this. Then we have the managers, we have auditors who are always asking for this. Then also we have the Kenya Revenue Authority and all other regulatory agencies. Some customers will also ask you for this financial statement to help them to evaluate the performance of your business. They are going to make economic decisions based on the financial statements that you give them. Then in the process, it is also estimating the future risks and potential of your business. You assess the future potential and what risks are likely to come about. By looking at the past and the present, you're able to make a decision about the future. So when you're looking at financial statement, I want you to think of your financial statement like a vehicle's dashboard. You have the dashboard. So just like your vehicle, okay, it has gauges that will let you know the status of the vehicle. Your business has a similar dashboard in its financial statement. So when you look, if you look at your dashboard, the speedometer, it will tell you how fast you're going. It measures the speed only since the beginning of the drive. It is going to measure the speed only. So the profit and loss statement works in the same way. It tells you whether you are making a loss or if you're making a profit. Are you losing money or are you gaining money? Just like the way, are you increasing speed or reducing speed in your speedometer? Then we have the odometer of the vehicle. It will always tell you how many kilometers the vehicle has traveled since the beginning of its use. Regardless of how much fuel you have put into it or how fast you went, it will tell you how many kilometers have you traveled since you bought that vehicle. The balance sheet works in the same way. It tells you how much value your business has since you started the business. It is a cumulative statement and it answers the how much is my business worth right now? What is the mileage? How many kilometers have I traveled since I started? That is your business. That is the balance sheet. And it considers the impact of everything that has happened, just like the odometer. Okay, everything. Where you have sold assets, you have had liabilities, you have paid them off, and all that. That is what the balance sheet tells you. It is your odometer. So just like any of these gauges, gives you the direction and the insights into the status of the dashboard will give you into the status of your vehicle. The financial statements, they do the same for the business. And this webinar will help you gain skills on analyzing your financial statement. And now as you look at it, can you imagine driving a vehicle without monitoring your dashboard? What could go wrong? Let's go for 2 minutes. You are driving your vehicle, which you are saying this is your dashboard. What could go wrong if you drive your vehicle without regularly monitoring the status of your dashboard? Let's share on chat. What could go wrong? And Jimmy, you can share with us the answers as the suggestions as they come through.
Okay, Robert says you could run out of fuel, you could overspeed, an accident could happen. Wow, thank you very much for your responses. Possible accident, overspeeding, overheating, all right? And the responses are coming in. Thank you very much. The vehicle can stop anytime because of lack of fuel. Thank you very much for that. So over to you, Esther.
Thank you. Thank you for those responses. You can just see. So failure to monitor your dashboard has the potential of causing chaos and disaster in your driving experience. So in the same way, failure to monitor your financial statement can threaten the success of your business. And you can monitor your business dashboard using two separate but related techniques. And we are going to get into these techniques. The first one that we are going to look at is comparative analysis. It is one way of monitoring the dashboard of your business. And let's see how we do that. So in this lesson, we are going to define comparative analysis. Then we see why it is important and how we can apply this analysis technique. Okay, so let's look at the definition of comparative analysis. So comparative analysis, it is also known as comparison analysis. And it is about measuring the financial relationship between variables over two or more reporting periods. So comparative analysis, it provides you useful information about the trends and the relationship over a period of time. So you are going to compare items on the same row. That is comparing sales for this year and sales for last year. And you'll be able to calculate the increase, the percentage increase and decreases in your statement. So that is what we calculate. So, and also you'll be able to spot out threads and relationships. When we do this, you'll be able to spot the threads and the relationship from one period to the other. And in order to compare items on the financial statement, you need to choose the base of comparison. And some of the bases that we have for comparison are these. You can use past data. The base is your past data. That is, for example, this year versus last year, this month versus last month. For example, you can decide the sales in July was probably 100,000. And you compare that with the sales in August, which are about 160,000. You're comparing past data with the current data. Then also you can compare planning data. This is where you compare the actual performance versus the budgeted performance. The other area you can see your base data, you can use the industry data. In the industry data, you're comparing my profit margin, for example, with the industrial profit margin. If in the pharmaceutical industry, what is your profit margin as compared to all the businesses in the pharmaceutical industry? So you compare the data. For example, you may find that your gross profit for the business is 50%. When you look at the industry, you find that the gross profit is 65%. So comparative analysis, they help you to calculate variations from one period to another, and this is the formula that we use. You take the new, you minus the old, you get the absolute figure in terms of the variance. New minus old, you get the absolute figure. So, and then when you go to percentage, the percentage change, you just new minus the old, then you divide by the old, you multiply by 100. In this case, what you're considering is the variance that you got, and now you put it in a percentage. So this is what I want to bring across. It is important for you to compute the two numbers, the amount of money in Kenya shillings and the percentage variance. And the reason is, when you compute the two numbers, what may look very insignificant in percentage, for example, a 2%, may be quite significant in amount. It may actually be totaling to 2 million. So a 2% may actually be running into millions of shillings. So it is always important to compute the two. And now I want us to look at an example. Let's do this example together and we do a comparative analysis. Remember, we are running. So let's look at this. And I would like you to calculate the variance in terms of the absolute amount and then the percentage variance of the sales. We have 2 minutes. August, the sales were 160,000. July, which is the old, we had 100,000. Let's calculate the variance. New minus the old, and then we go to percentage variance. Okay, the formulas are on the screen. Let's start getting the answers on chart. We have 2 minutes. And Jim will give us the answers as they come through.
Yeah, one just in here, we have 40,000 and a 40%. Okay, there's another one, 60%. Okay. All right, 60%. So it seems 60% is taking the lead here, Esther.
Okay.
So I'll hand it over back to you. Thank you, Anjiru.
Okay, thank you for those responses. And I can see the math is going on very well. So 60% increase in sales, and we can say it is quite impressive. The moment you get this, you need to ask yourself now to explain the reasons. You need to explain the reasons behind the change. And some of the reasons could be there was a change in the pricing strategy. There was a change in pricing. And also, there could be having a change in the selling strategy. That is what led to the 60% increase. So if you wanted to compare your business performance against the budget, you can apply the same technique. And we are going to use an example. Let's say, and this we're also going to do together. You have salaries here. You budgeted salary of 90,000, but the salaries that you actually incurred is 110,000. What is the variance in terms of the absolute amount and also in terms of percentage? Let's calculate this. The formulas are on the screen. Jim will take us through the responses as they come through.
Okay, let's see what we have. I think we are still processing.
Okay, we have the variance. For you to calculate, you take actual minus the budget. Then when you go to the percentage variance, it's actual minus the budget divided by the budget times 100 for you to get the percentage variance.
So we have 30,000, 33.3%, that's Edna. Another one says 20 with a 22.2%. Mary says 22%. Okay. Thank you, Elizabeth. So the 20 and the 20%, 22% is taking the lead here.
Okay.
So let me hand it over to you, Esther.
So thank you for your responses. And so in this case, we see it is a 22% increase in salaries. You budgeted for 90, but you have incurred 110. So that means you have spent over with 22% beyond what you had budgeted. And this is a red flag for you to be busting your budget in terms of expenses. And you now ask yourself, why did I bust? Why did I pay more salaries than I had budgeted? Probably there was an increase in overtime payments, or there is a very high possibility you recruited a new staff. So it is always important to get the explanation behind the change. Without analyzing, you will not know probably there is a change. And the percentages help us a lot. So as you see, you're able to really spot the threads and the relationship between different items in different periods and seek explanation. And now we are going to go to the comparative analysis of the profit and loss statement for the XYZ company. Look at this statement, okay? Look at the statement. In this case, we have already seen, you know how to calculate the variances, that is in terms and numbers. In this case, we have calculated the percentage changes for you, okay? And now all that is remaining is for us to focus on the interpretation. So I want you to look at this statement. This comparative analysis, look at the column on the percentage change and share with us your answers. So based on the threads on this statement, what impresses you? What impresses you about this statement? Just look through it, look at the column on percentage change. What impresses you about the statement? Share with us on chat. We agreed we participate so that we are able to learn. Study the statement. What impresses you?
So one says profits. Operating profit is at 51%. Ansieta says the health growth in sales revenue. Eva says raw materials. Operating profit is up by 51%. Decrease in expenses. And then Robert says increased in profits. Reduction in utilities is also another comment here on what impresses us. Sales revenue increases. Okay. So over to you, Esther. And thank you guys for your responses.
Thank you. That is so good. And we can see already we know how to analyze the statement. The moment we have our variances in percentages, we're able to see. We see there is an increase in sales. And also we see that there is general increase in the profits, all the way from the gross profit, the operating profit, and the net profit. So we can say the overall performance of the current year is better than the previous year. Now, I also want you to look at it. Based on the trends, what concerns you in this statement? What are your key concerns? What are your key concerns?
So the major concern is an increased operating expenses, increase of overheads by 60%. Edna says overhead increasing at a high rate. Okay, so there's a concern on the overheads, operating expenses, increase in other expenses. Okay, so over to you, Esther.
Okay, thank you. You see, with all this analysis, you are really able to spot the concerns. The increase in expenses, it's a big concern. So comparative analysis gives you signals to do some investigating to find out what the variances are all about. That is part of what the statements do. They put up the red flags for investigation. The analysis, one thing, may not always give you the answers, but it helps you to determine the right questions to ask. Wouldn't you also be curious now from the analysis that we have done here to know what insights you can get from the balance sheet of the XYZ company? So let's look at the balance sheet. Here we are. We have the variances already calculated. Okay, this is already done. Now let's really examine this balance sheet for 2 minutes or so. And then, based on this, what trends impresses you in this balance sheet? Look at the balance sheet. What trends really impress you? Jimmy, when the answers come in, let's just go through it.
Okay, so one says reduced current assets, increase in total asset, reduction in account payables. Okay. All right, thank you very much for that. So over to you, Esther.
Okay, so when you look at this particular balance sheet, one of the things that you note, the accounts receivables have reduced by 38%. That means 38% of the amount that was owed has now been paid. Your debts to the debts to the company have reduced. If you look at the short-term investments of the business, they have doubled. The short-term investments, they have grown by 100%. Then the fixed assets, they have also increased by 67%. So those are some of the things that impress you. Once you see your asset side is increasing, then that is very impressive. When your customers are paying their debts, that is impressive. Now, examine it further, sorry. What are trends in this balance sheet concern you? What are your major concerns from this balance sheet? Look at it very closely.
Long-term debt is one of the concerns we have. An increase in owner's equity. Another one says 600% growth in debt. Long-term debt. Looks like the asset growth is fueled by debt. Okay, thank you, Eva, for that. And then Vienna says long-term liabilities. Okay, long-term debt is high. Increase in fixed assets. Thank you for that. So over to you, Esther.
Thank you. And it's very impressive to just hear, asking yourself why, what are the concerns? And you see the 600% increase in long-term debt. Then you go back that the assets increased, and you say that the increase in debt probably is the one that is fearing the increase. The increase in debt is the one fearing the increase in assets. Then if you look at the prepaid expenses, they have gone up by 50%. So you are paying more outside, you are starving your business of cash. You are paying, if you look at the accounts payable, you have paid your suppliers. There is an increase, you have dipped with 49%. So you are getting less debt from your suppliers. Those are some of the things that you need to ask yourself. So you see the concerns that come on board, you are able to ask the right questions. There may not be a problem because of the 600% increase, because it may be related to a one-time expense. When you ask yourself the question, but it is important to explain why this happened. And based on your experience in comparative analysis, let's see, what have you learned so far? What have you learned so far? Okay, in the chat box, let's just share. From your experience in the comparative analysis of XYZ company, we have analyzed the profit and loss account and the balance sheet. What have you learned so far? Just share with us in the chat box.
Okay, let's see what we have learned.
Yes, and as we go along, if you have any question, put it in the Q&A and we'll be able to answer it. Either
Okay,
as we go
one
along,
says, variances
yes,
tell a story. I have learned how to compute variances. Okay, comparing different data provides good insights. Importance of analyzing financial reports. Always bargain for credit terms from suppliers. Okay, you can use any analysis to the business. The importance of financial analysis in business success. And then let me take one last one here. Jennifer says it's always good to check your profits, debt payments, and of course, balance sheet. And other responses are still coming, so I'll hand it over to you, Esther.
Thank you. And we can see the responses are coming. So that means you have learned a lot, and it is so great. So comparative analysis, they can tell you if your business is improving from year to year. So what if you wanted to know if your investment is really worth it? Is it worth it? How could you use how much money each shilling that you invested is actually making? It's always good to look at that. And we do that, we find out that variable information by doing cross-report comparison. And this is what we are going to look in our next lesson. For you to be able to know each shilling that I've invested in this business, how much is it making? And that is where we go to the ratio analysis. So I just want to ask you, have you ever been in a situation where you need to borrow some money? Then you approach your relationship manager, probably Peter, at the bank to discuss your options. When you are visiting your relationship manager, you want to borrow some money, the first thing you are discussing your option. If you have ever noticed, the conversation never ends without them asking for financial statements. And have you noticed that also, that once your relationship manager has had a chance to review your financial statements, they are then ready to give you a definite either yes or no. Peter will tell you yes or no, but only after she has looked at your financial statement. So what do you think the review of financial statement is all about? Prospective lenders, they review financial statements by performing what we call ratio analysis. They want to get information from your financial statements about your profitability, your ability to pay the loan, and the level of debt the business uses to fund its operations. Those are the three main things that your relationship manager is usually looking for: your profitability, your ability to pay the loan, and the level of debt that the business uses to fund its operations. So in this lesson, we are going to help you to perform the financial analysis so that by the moment you go to face your relationship manager, you have done this. And financial ratios, they can be expressed in numbers, decimals, or percentage values. So this lesson is going to help you to be a step ahead at all times and discover the areas of concern. We'll let you see how the structure of our learning of the ratio looks like. So this is what we are going to look at. Also, we are going to learn about the three categories of financial ratios that are used. And for each ratio, we are going to define it, explain its importance, and also, most importantly, learn how to interpret it. We are going to learn how to recognize the red flags, that is something is not going right, that needs to be fixed to enhance the business success. And we're going to perform the financial analysis of the XYZ company before we go ahead to highlight the limitations of financial ratio analysis. So we earlier talked about the dangers of driving a vehicle without monitoring the dashboard. What financial items do you frequently monitor in your business? What financial items do you frequently monitor in your business? Let's share on chat. What do you monitor in your business? Share with us what you monitor in your business. Okay, do you have some answers coming through on chat,
Yeah,
Jimmy?
so we have income and expenditure, daily sales, bank and cash balances, sales turnover, income, invoice. Another one says the capital profits and losses, payments, cash flows, and the list goes on. Thank you very much. Let me take one last one from Kevin, says income, expenditure, and debt. Over to you, Esther.
That is good. And it is just wonderful to see that really you are keeping your eyes on the controls of your business dashboard. You're monitoring. So financial analysis gives you the skills that help you to spot potential problems in your business just by glancing at the dashboard. While you're driving, that is what you do in terms of your business now in this case. So when you are looking at the ratios, we simplify them and put them in 3 groups. Okay. And your choice of the financial ratio that you're going to use, it's usually determined by what you want to know, not what is available. Ask yourself, what do I want to know? You have profitability ratios. These ones will help you to decide, to make decisions on ability to make profit. The question you are asking yourself is, am I profitable? These ratios will help you to evaluate the ability of your business to make profit. Then you can look at the liquidity ratios. When you're looking at the liquidity ratios, the question you're asking yourself is, can I pay my short-term debts when they fall due? So liquidity ratios, they help you to evaluate your ability to pay your short-term debts. Then we have the other category of ratios, what we call the debt ratios. And the question you're asking yourself here is, what is the portion of debt financing in my business? This ratio, it helps you to evaluate the size of debt in your business capital structure. They show the long-term financial and operating structure of your business, the debt ratios. Your ability to make profit can be commendable, but making profit is a short-term indicator of business success. Did you know that there is more to do in order to guarantee the long-term success of your business? And in this case, we are going to tackle the issue of profitability by looking at the profitability ratio. Okay? And it is an indicator of the business success. Profitability is actually an indicator of the long-term business success. And with this, I'll share with you a story. Listen very carefully. Meet Faraja, who has been in business for the last 3 years. Although her business is making profits, she has been having challenges in managing the business and believes that there must be a more efficient way of running the business. But she's not sure on what it could be. So she confides in her brother Moses, who asks her about her profit margins. This term is not new to her, and she hears people talking about it, but she honestly does not know what it is. So Moses tells her that the profit margin is a measure of profitability. Faraja believes that learning and applying profitability is the big break she has been hoping for. So in that case, Moses shares his performance with Faraja for the month of August and asks her, which is the most profitable farming venture? Moses is in farming. And now I want you to look at this. Study this. This is Moses' statement for August on sales and expenses and the profit. Which is the most profitable farming venture? The most profitable? You calculate profit, sales minus expenses. So which is the most profitable? If you are to look at it, we have the profit over there already. Share with us on chat. Which is the most profitable business?
Okay, so we have horticulture.
Mm-hmm.
Majority are saying horticulture, though there's some other comments here from Robert Bernard are saying fish farming.
Mm-hmm.
Steven says fish. Joseph says fish farming. Okay, so we have both fish and horticulture comments.
Okay.
Okay, let me take one comment from Corey. It says farming because less capital, but much return. Okay.
Okay.
So over to you, Esther.
Thank you, Jimmy, for taking us through, and thank you for those responses. As you can see, there is fish, there is horticulture. So what you find is that it is misleading to assess profitability of your business by simply looking at the face of your financial statements. You can only be sure after you measure profitability by the use of ratios. The most important ratio in measuring profitability is called the profit margin. So there is that answer that you have given. So let us revisit it later when we learn about the profit margins, okay? But to do that, let's start with the definition of the profit margin. Profit margin is the percentage portion of profit that the business has generated for each shilling of sales. It is dangerous to assume that selling more in volume and value is an indicator of your business profitability. So likewise, making more profit in money amounts is not necessarily a measure of profit. The profit margin is an indicator of the business efficiency because it tells you what portion of profit the business keeps on every shilling sold. The profit margin is computed as follows. You get the profit, you divide with the sales, and you multiply by 100. So what you realize is that costs and profits, they have an inverse proportion. The more you are able to reduce the business costs, the more profit you make. Every shilling saved through cost cutting increases your profit margin, which is the measure of efficiency. But you should note to be careful to ensure that your quest of cost cutting does not compromise the quality of your products and services because you end up losing customers. So now let's revisit the financials of Moses for his farming ventures, and we calculate the profit margin since we have the formula with us. Okay, so, and we see which is the most profitable. So here we are. We have the business with us, and we can be able to calculate the profit margin. Profit margin is profit you divide by sales times 100. Please calculate. Let me give you about 1 minute to calculate the profit margin for these 3 businesses. And Jim will give us the answers as they come through. What is the profit margin? Profit divided by sales times 100. And you ask yourself.
So we have Raphael says 40, 30, and 20 respectively. That is for fish farming, poultry, and horticulture. Innocent says 40, 30, and 20%. Wow. Another one says fish farming is 60%. Okay.
Okay.
And a couple of same responses of 40, 30, and 20%. So I'll hand it over back to you, Esther.
Thank you. Now, looking at that you have the profit margin. Here it is. Which is the most profitable farming venture? Remember the question we had, which is the most profitable? Now looking at the profit margin.
So fish tends to be the most profitable here, according to the submissions I'm seeing. Okay, thank you for that, Titus, Jacqueline, Timothy. All right, so over to you, Esther.
Thank you. Thank you, Jimmy, and thank you for those answers. So when we asked the same question about the most profitable, we came up with the answer horticulture. Of course, we had some with fish, but quite a number with horticulture. So as it turns out, after you have done the profit margin, farming is the most profitable despite having the lowest sales and profit. Horticulture is now the least profitable. So this is what we see. For every 100 shillings fish we get from fish farming, it costs us 40 shillings. We make 40 shillings. While in agriculture, the cost of 80 shillings, that the cost is actually 80 shillings, which is double. Okay, so that is where we are making less money. So fish farming, for every 100, we are getting a cost. We are making 40 shillings for every shilling. And then for horticulture, for every shilling, we are only making 20 shillings. So profit margins, they help us to measure your efficiency in cost containment. And we have to come up with the strategies to increase the revenue. We get to know the strategies. So when you recall the profit and loss statement, it has 3 profit measures. And we can apply the profit margin calculations that we have seen to calculate each of the profit measures to tell us about the business efficiency. So here we are. We have the gross profit. Using the same formula, now we go to gross profit margin, which is gross profit you divide by sales times 100. And in this case, we are measuring the percentage portion of profit a business makes for every shilling sold after deducting its direct costs. Okay, how efficient are we in our production? Then we go to the operating profit margin, which is operating profit, you divide by sales times 100, and this one usually tells us the percentage portion of profit a business makes for every shilling sold after deducting its operating profit. And in this case, you're looking at operating profits, that is, how efficient are we in containing our overheads? How efficient are we? Then we go to the net profit margin. In net profit margin, it's net profit, you divide by the sales times 100. And what we are looking at, it's the percentage portion of profit that a business makes on every shilling sold after deducting all the expenses of the business. So the net profit, what we are looking at is expenses, you have subtracted everything. You have subtracted all the costs, even the depreciation, the interest, and the taxes. And the net profit, it is what is commonly referred to as the bottom line. It is the true indicator of a company's profitability. And now let us look for more understanding into the into the margins of XYZ company. Okay, let's look as we go through, let's see how we come through. So when you go to the gross profit, to just recap, we usually have the sales, then you remove all the cost of sales for you to get your gross profit. Okay. In this case, we are looking at production efficiency. When you calculate the gross profit margin, you are looking at the production efficiencies. So streamlining production is important because it will help you to cut down the cost and push up your profitability. The more efficiently you run your production, okay, the more efficiently you run your production processes, that is by reducing the cost, the higher your gross profit margin. Then let's go to the cost control, that is the overheads. This is measured by the operating profit margin. It measures your effectiveness of controlling your cost. A higher operating margin indicates that the business is earning enough money from business operations to pay the associated costs involved in maintaining the business. So operating profit margin indicates the management's ability to cut down operating costs. Every shilling saved increases the profit margin. And it also indicates the riskiness of your business. Low operating profit margins are risky because you may not be able to pay your debts or your taxes. Then let's go to the other area of investor return. In investor return, this is measured by the net profit margin. It helps you to assess the ability of the management team in running a business profitably. Net profit margin is one of the most important indicators of a company's overall financial health. It is going to help us to understand the investors, what I invested, am I able to get a return? So I want us now to see the gross profit margin of XYZ company. Let's go through. Okay, so here we are, we have the gross profit of the XYZ company. Now look at this and let's calculate what is the gross profit margin for this company, the XYZ. Let's calculate this. The gross profit is 475,000. The sales revenue is 420,000. To calculate the margin, you divide and multiply by 100. What is the gross profit margin? Jimmy, when we get the answers, let's just go through them.
So 66 or 65% is what we are getting so far. Okay, 66, 65.97. So the majority here, we are saying 66%.
Okay, that is great. We have the answer as 66%. Okay, so what if the gross profit margin was as low as 35%? Would it concern you? And if it would concern you, why? What if it was lower than probably all the way to 35%? This is the gross profit margin. Would you be concerned? And if so, why? Okay. Would there be a concern if the gross profit was 35%? Jimmy, do we have any answers?
Yeah, so our concern will be the high cost. That's Innocent. And another concern will be low profits. That's Huntington.
Yeah, we are looking at high cost, low profit, with the possibility to not be able to cover our other costs. Now let's go to the operating profit of the XYZ. In this case, let's calculate it. You have the operating profit as 284,500 and the sales are 720,000. What is the operating margin for this business? What is the operating margin? Let's share the answers on chat.
Okay, so Ramadan says 39.5. Robert says 39.4, 39.5, 39.5. All right, so there you have it, 39.5.
Wow. Okay, so let's round it off to 40%. So what you notice is that a high operating profit, it indicates the business is earning enough money from operations to pay its associated costs. A low operating margin is risky because the business may not be able to pay its costs. Now, I would just like on chat, just share with us some ideas on cost cutting. How can a business be able to cut costs? Like, look at your business. How would you cut costs in your business? Some cost cutting ideas. We are here to all learn. What are some cost-cutting
David
ideas?
says, reduce staff.
Mhm.
Another one, Mary says, reduce overhead, as well as reduce inventories.
Mhm.
Automation is one of it. Joshua says, use of ICT. Let me take two and then we proceed. Reduce wastage, automation of manual processes, reduce overtime, and move to online marketing. Okay, over to you, Esther.
Thank you. Thank you for those responses. Thank you, Jimmy. So if you want to enjoy high operating margins, you need to find creative and practical ways to reduce your own indirect costs of what we call the overheads. And so far, all operating costs of the business has been paid for. Now you need to assess the ability of the business to deliver a return to you as the business owner. After absorbing all the non-operating expenses like the interest on loans, the taxes, any foreign exchange loss, any losses on lawsuits. So the ratio now to watch for is the net profit margin, and you're going to go to the net profit margin of the XYZ company. Let us see where they are. So here we are. They made a net profit of 241,500. Their sales are 720,000. What is the net profit margin? What is the net profit margin? We have about 45 seconds. Calculate the net profit margin and put it on chart.
So we have one here, 33.5%.
Mm-hmm.
Okay, 33, 34. Okay.
Okay.
33.5, 33.5. So there you have it, Esther. Over to you.
Thank you, Jimmy. It's unanimous that we have 33.5. So in terms of interpretation, low ratios mean the business is not producing enough to sustain itself. And the business may make a loss, which erodes the owner's capital. When you're interpreting in terms of looking at the profitability. So if you look at the XYZ company, what do you think the company could do to maximize their net profit margin? What do you think they could do? If this was your business, what would you do to maximize profit? Share with us on chat.
Raphael says he will increase sales, reduce cost, reduce operating cost.
Okay.
Okay, reduce cost, cut cost. All right, that takes the lead. Over to you, Esther.
Thank you. Those are some of the suggestions on what XYZ should do. To ensure that you increase this, you can diversify income. Invest some of the money that you're getting. You can also ensure that you are tax compliant to avoid any penalties. You can pay your loans on time to avoid interest penalties. You'll be able to increase your profit. So we have analyzed the profitability of XYZ using all the profit margins. And we have seen we can dig out some very hidden information, secrets that can be able to make us make decisions. So now, can you see just how ratio analysis can help you improve your business decisions? Now, what about if you wanted to find out about your ability to generate cash to meet the day-to-day business running expenses? What ratios would you look at? In this case, we look at liquidity ratios. And most of the time you find that, have you encountered a situation where you have run out of cash or almost run out of cash in your business? Have you ever encountered such a situation? You have run out of cash or you have almost run out of cash? Let's see, are there people who have been in such a situation? Jimmy? Are there people who have been in that situation? Okay.
All right, so there are yeses here as we speak.
Okay,
Esther?
I can see some yeses, some raised hands. Yeah. So what you realize is that this situation can easily happen if you don't closely monitor your business dashboard. The car will run out of fuel. Performing liquidity ratios are going to help you to spot out the red flags early enough, and you can make corrective action to avoid the element of surprise. Running out of cash can grind your business operations to a halt. To avoid that from happening, monitor your liquidity ratios closely. The liquidity ratios refers to the ability of a business to convert short-term assets into cash for business use. And now we are going to see key liquidity ratios needing close monitoring. So we have what we call the working capital. Working capital is current assets minus current liabilities, and it gives you the ability to finance the day-to-day operations of a business. Then we have another ratio that we call the current asset ratio. This is usually current assets you divide by current liabilities, and it is the ability of a business to convert the current assets into cash to settle the short-term debts and payables. The other asset that is very important is the quick ratio. This one, it's usually current assets, you minus the inventory, you divide by liabilities. And it is going to measure the ability of a business to convert its current assets into cash to settle short-term debts and payables without relying on selling the stock, because sometimes stock can take a bit of time. So it is in your interest, okay, to ensure that you look at these three ratios so that you're able to settle your short-term debts. So the first thing to monitor in your business is the ability to convert short-term assets into cash to be used to pay short-term debts. And the liquidity measure here is that working capital. So in this case, when we look at the XYZ, we find that they have current assets of 945,000 and current liabilities of 560,000. What is their working capital? That is the amount of cash a business has to finance its day-to-day operations. Please calculate and give us the answer. What is the working capital of XYZ?
Okay, so Esther, I know we are conscious of time. Let me pick two comments and then we proceed. So we have 385,000 from Ezekiel, and another one, 385,000 from Wanjiru. So over to you.
Okay, thank you. 385,000, that is our working capital. A high net working capital, it's a good sign for the business, since it provides some buffer to accommodate additional liabilities. However, excessive current assets may not be good after all, because they could mean that we need to invest more in productive assets. We can do some additional investment, we can buy some assets. So that is what we need to look at. A negative working capital is a red flag that the business will not be able to generate sufficient cash to pay short-term liabilities. And that will lead you to technical insolvency. So those are some of the things that we need to be looking at. So you may want to know at all times how many shillings of current assets the business can convert to pay 1 shilling of short-term debts. And in this case, this is where we go to the current ratio. And let's look at XYZ. They have current assets of 945 and current liabilities of 560,000. So how are they rated in terms of, let's get their current ratio. How many shillings of current assets that the business need to convert to pay every shilling of short-term debt? Let's look at it. What is the current ratio? Let's get to responses, Jimmy.
So we have 1:69 and 1:69 from Ezekiel and Joshua and Justus.
Okay, thank you. Let's go with those two. So 1:69. So the current ratio, it's mainly used to give an idea of the business ability to convert short-term assets into cash to pay short-term liabilities. And as a general rule of the thumb, a ratio between 1 to 3 is healthy, although this depends on the industry. Businesses with ratios slightly below 1 might have trouble getting paid by their customers, or they have to buy some more inventory to store for a long time. And this can cause temporary liquidity issues. So as we look at this, we should know that a company should always be having current assets that they can easily convert into cash so that they're able to service their overdrafts, to pay taxes, and to pay any bills that are coming up. Now, what if there is an emergency and we need to quickly raise money to pay our debts without selling our stock? In this case, we look at the current ratio. And let's see how the XYZ company is faring in the quick ratio. We get the current assets, we minus the inventory, we divide by current liabilities. And in this case, the current assets for XYZ is 945. Let's do the question as we go along. The inventory is 35,000 and we have current liabilities of 560. What is the quick ratio? Let's have two answers. Okay.
So we have 1.63, that is 1:6.3. That's in Tabo and Robert. Thank you for that. Over to you, Esther.
Thank you. So we have 1.63. This ratio is more refined. It's a more refined measure of liquidity. It looks at a business' immediate ability to generate cash from the current assets without looking at the stock. The higher the ratio, the better the company's cash health. The lower the ratio, the more likely the business may struggle to pay its debts. A strong cash ratio is useful for creditors when deciding how much debt they would give you. That is, they would extend to your company. And that is what we really need to be looking at. So this far, we have come and we have seen how we can easily convert the current assets into cash to be able to pay our debts. So we have learned about the profitability ratios and the liquidity ratios, but we have not yet considered the impact of debt on the business to pay. That is, are we able to pay our debt? That is what we are going to look at, debt ratios. So liquidity ratios, we have been able to see, they assess the ability of the business to generate cash to pay short-term debts. Debt ratios focus more on the company's ability to pay off the long-term debt, which is known as the solvency. Solvency depends on the business earning power. That is, a business needs to earn profits to service the debts. This is the net profit margin that we talked about. So the net profits of the business they usually increase the owner's equity. Debt ratios measure the overall debt load of a business in comparison to the assets and to equity. There are two main debt ratios that we look at. We look at the debt to asset ratio. This is the ability of the business to raise enough money to pay all its debts if it were to sell all the assets in the business. And what we say here is a ratio of greater than 1 shows that the business has more liabilities than assets. It probably used loans to buy all its assets. And a high ratio indicates that the business may be putting itself at risk. Okay? It may put itself at risk of default on the loan plus the interest. So a ratio below 1 indicates that a greater portion of the company's assets are bought using the owner's equity. Okay. Then the other ratio we look at is the debt to equity ratio. It measures the portion of debt versus the owner's equity. That is, what did the owner use to buy, what portion the owner has financed, what portion of debt is there compared to what the owners of the business have contributed. So the higher the ratio, the more risky the business has, because it means that more of their wholly owned funds are going to go toward paying loans and interest rather than investing in the business. Usually it shows that a business has financed much more of its growth through the loan. So it is hard to give a rule of the thumb or safe number in terms of this ratio, because it depends on the industry and the country. Some industries, such as like now automobile manufacturing, they have a very high capital equipment cost. And so for them, their debt to equity ratios tend to be around 2. But other industries such as consulting, they have very little need to buy expensive equipment, and their ratios can actually be around 0.5. They're mostly below 1. So it depends on the industry and also the country, depending on where you are. So in all this, now let's see at where our company is, the XYZ. How are they managing their debts? So in terms of the debt ratio, we look at the total liabilities, we divide by the current assets. And looking at what we have on the screen, what is the debt ratio of XYZ company? Total liabilities is short-term liabilities of 560,000 plus long-term liabilities of 900,000. You divide by the total assets of 3.62 million. What is the debt ratio? Debt to asset ratio for XYZ. We can take probably 1 or 2 answers. Jimmy, do we have some answers?
So we have 0.4. Anthony, thank you for that. Robert, 0.4, thank you for that.
Okay.
All right.
Thank you for that. So here, our answer is 0.4. The ideal is 1. So a higher ratio means greater risks associated with the business operations, while a lower ratio means more opportunity to borrow and no significant risk. Like now, when we look at XYZ company, they have a room to borrow. They have a room to borrow, they can borrow some more. So if you need to assess now the portion of debt in relation to owner's equity, then we look at the equity ratio. let's see what our XYZ company has. Their total equity is 2.16 million. The total liabilities is 560,000 plus 900,000. What is their debt to equity ratio? We can get two answers or more. Okay. So that we ensure we save on time.
0.68.
Okay, thank you. So we have that this company has 0.68 as their debt to equity ratio. So the optimal debt to equity ratio, it's usually considered at about 1. That is, your liabilities should actually be equal to your equity. The relationship of the equity to the total liabilities, it is very important to measure the capital structure of a business. As shareholders' equity increases in relationship to the total liability, the margin of protection to creditors increases. Other things remain unchanged. So the enterprise is less vulnerable to declines in business or in the economy. So the cost of carrying debt also reduces, and the business should be able to meet its obligations more easily. And this is what is seriously looked at by bankers. So in general, a high debt to equity ratio indicates that the business may not be able to generate enough cash to satisfy debt obligations. However, a low debt to equity ratio may also indicate that the business is not taking advantage of the increased profits that financial leverage may bring. The ratio shows the portion of debt obligations against the owner's equity, and it is very important in lending. So when we look at a debt ratio of 6, at a debt to equity ratio of 0.68, it means that the claims in relationship to the company's total debt is less than the amount invested by the owners in this case. Okay, so we have seen that financial ratios, they give us very helpful insights on the performance of a business. However, the financial ratios have limitations. They must be based on accurate financial statements. They're as accurate as your financial statements. They consider ratios together with absolute figures, because a certain percentage in terms of absolute figures can be a very big amount. And they are most useful when compared with companies in the same industries. You can't compare companies which are not in the same industry. Then balance sheet ratios usually depend on a snapshot taken, that is at a particular point in time. So you have to keep doing them over and over again. So looking at all this, we conclude our learning on ratio analysis. And with that, we conclude our course. We come to the end of our course. And to do that, let's go back to our learning objective and see whether we have been able to achieve it. So now, from now, you should be able to, 1, explain the importance of financial analysis, which we covered in our first lesson. Also, to perform the comparative analysis, and eventually to perform the ratio analysis, interpret them, and also be able to know how you can be able to apply them into your business. So we have covered all this. So looking at what we have covered, now let's go to an implementation plan. How do you plan to implement the lesson that we have learned? In the chat, just share with us 2 new ideas that you're going to implement from what we have learned today. Reflect on what we have learned, share with us 2 new ideas that you're going to implement in your business. And Jimmy is going to share with us as we go, as they come in.
Okay. So Njeri is saying she's learned to look at her numbers more closely. Thank you very much for that. And Elizabeth says she has gotten an understanding of ratio analysis. Okay, monitor the dashboard is something that Patrick is taking away. Calculating my financial margins. Thank you very much. Okay, and the comments are coming in here, as you can see, over from your end, Esther. To keep financial records, more insight on financial analysis. Thank you very much, guys. So over to you, Esther.
Thank you. At least we see that we have learned something. So what I urge you, implement and practice the ideas that you have learned from this training. It's going to enhance your analysis of financial statement and the use of your financial statement. So let's look at what the series of webinars that we have lined up for you in future. So today we have covered using financial analysis. Next week, we'll look on the topic of profitability. We have looked a bit on profitability, we'll cover that. Then we'll look at cash flow management later on. Working capital management, very important, so we have put it in 2 sections. Then we have the loan management, and eventually after you have done all this, we have savings and investment that we are going to cover in 2 sessions. And now that we have been through all this, I want you to watch out for the next course, which is on profitability. And also go ahead and perform financial analysis for your business. Let's complete an evaluation. Jimmy will give us the evaluation for us to complete, and also we look at the questions that you have. So Jimmy, please share the evaluation. How has the session been to you?
All right, thank you very much, Sarah, for such a great presentation. And I have launched the poll. So the poll will be running as we put in our polls on how the session has been. And at this juncture, I would like to thank our online colleagues who have been answering questions in the Q&A, Gideon, Winnie, and of course, Anthony. So I'd like to hand it over to Anthony to just give us a very brief overview. I know we've overrun in our time on the CoopBank side. So Anthony, thank you very much. And the floor is yours.
Okay, thank you.
Thank you so much, Esther, for that insightful session. From the poll, you can see a lot of us have actually gained from the session. We have taken some time, but we felt that was very insightful. And thank you, customers, for sparing some time. Thank you for sparing some time out of your busy schedule. We don't take it for granted. I don't know whether you can see my quick presentation. Peter, confirm. You can see my quick. I'll take very few moments, just wind it up.
Yes, it's coming actually.
Can see it in full screen. Yes, and just also to put our commitment, assure our commitment to our MSMEs out there. I think the COVID pandemic has taught us a lot of things. We have learned to do things differently, even as a bank. And I'm happy to say that we have done over 50 webinars to our customers just to equip them and ensure that we keep you abreast on what is happening outside, because it's very critical, because the skills that we give you will ensure that you're able to navigate and also see more opportunities for you that you're able to take or leverage on. Why this? Why financial statement? Again, I want to say, just like Esther said, this is what we look at as lenders on the health check of your business. And it's very critical, because if you're approaching us for a facility, I think those of us who have interacted with our relationship managers across the branch network, I know at some point then we have been asked to provide the books of accounts. Then the other thing is the financial statements helps us to gives us a trend. And what Esther, just speaking from what Esther told us, is it helps us to see your past performance trend, and also we're able to project or give indication or indicators of how your business is going to perform in the next 2 or 3 years, especially for the duration that you'll be borrowing with us. So that was very insightful, and thank you so much, Esther. I know we have taken time, but I really appreciate, because even us as MSME proprietors, directors, others, our staff supporting the owners of the business, it's crucial for us to have those soft skills to be able to interpret the financial statements. So I think also for the bank, we haven't been left behind. I think we have trained. I want to confirm that the training that we have also been taken through has also, we have also had the same taken through in a deeper analysis to our over 400 business bankers and relationship manager that sits across the branch network. And then how this ties in is when you come to the bank and you want to get finance, whether long-term or short-term, then the books of accounts to a business, to an MSME, very critical. Once you're able to interpret, then it will make it easier for us, for you and us to have a conversation when you're looking out for the term loans that we are offering, the overdraft, whether you need the instant mobile loans, or whether you need support in paying our suppliers or distributors in case where you have delayed payments. These books will also help. I think from the bank, we assess your repayment ability based on the past trend, and you look at your financial statement, whether you are looking out for short-term or long-term loans, or you want to finance an asset finance or an acquisition, that will that the books of account and the financial statement will form a very critical ingredient to us deciding on whether to advance a facility. And I'm happy to say we have the working capital, we have whatever, we have the short-term, the long-term loans. We also have our e-credit, and possibly I'll spend a minute here to say, as an SME, as an MSME, I think one of the things that we have also done as a bank is to challenge ourselves and ask ourselves, are we able to look at the bankings from where we sit as a bank over an MSME, and just allocate you a limit that you're also able to borrow through your mobile phone. And we have been able to use data. Esther told us numbers will always tell a story. And based on the bankings that you'll do, then we're able to sit as a bank and at the back end, then look at your bankings and give you a limit that you're able to borrow up to $1 million and be able to pay to a maximum of 6 months. And I know quite a number of us have received SMS saying you have a limit of X amount and you can borrow or you qualify for a certain amount. And the simple things that we look at the consistent banking. We look at how you are keeping your financial statement, how you're banking with us. And this then helps us then to allocate you a limit. Just to proceed to say now, as a bank, and I think this is what I also want us to take through. As a bank, we have partnered with the government just to ensure that we also support the MSME. I know we have come from a very tough time. We thank God that COVID, the things, the economy is opening up. The restrictions, the red tapes put by the government at least are easing up. And what the government has also done, especially with co-bank, is that we have also joined hard in supporting MSMEs to ensure that we continue with the job creation and ensure that you're also accessing the fund. So this is something that I want us, especially for those of us who are in this call, once you're through with this, please visit your branch. We have made it easy. We have over 1.8 billion to lend to MSMEs. As long as you are in a business that is registered, you have a permit or a license, And if you're tax compliant, then please walk into any of cooperative bank. We are cognizant that we have come from a tough period, and the monies that we are now advancing to as working capital are meant to rebuild our businesses, because in any eventuality, when there is a crisis or there is a pandemic in a country, who gets affected most? I believe it's the MSMEs, yet we contribute a lot in terms of the GDP. So we have this working capital that you can use to rebuild your business, or acquire a business asset to be able to run your businesses efficiently. And also, we are doing this across all our branches up to a maximum of 5 million. It doesn't matter whether you have another facility with us, please walk in and liaise with our branch managers and our relationship managers. We are giving up to 36 months. And what we have done, so that we also encourage, we have given a preferential rate of 12.5%, which is slightly lower than the other loans. And of course, now, once you walk in, you're able to get within 24 hours. And it doesn't matter whether you have another working capital, please walk in, we'll be able to support. We're also flexible. We have also, if you have a security or a collateral with us, or whether you don't have any collateral, please don't shy away from coming to the bank, because we are flexible. We are offering both secured and unsecured up to a tune of 5 million. The last thing I'll talk about is on cash flow. I think for us to understand you from a bank perspective and be able to analyze your financial or financial statement well, what we continue encouraging you is the consistent bankings. And what our encouragers, especially all of us who are in this call, is to say, walk into any branch and ensure that at least you have an MCOP cash. That's a platform you can do all transaction with your phone. If you are operating a business, take advantage of the COP agents near you. There is a name collection solution that you have for those of us who are in business and you want to know who we want to get the narrations of who is paying you, what amount. I think walking to any core bank or any relationship manager to have a name collection solution, or where you want to integrate with us, we're able to integrate with your business and get real-time information on how your business is doing, so that we are able to pre-qualify you, give you working capital, and able to access your financial statement. That you can walk to any of our branches, the Lipa na M-Pesa, the merchants that we have, the PDQ, ensure, especially those of us in trade, hotels, ensure you have a PDQ machine with us, or what we call a merchant, so that all the transactions that you're doing are terminating with our bank, and we're able to offer you some of these facilities, or COP online, internet, or direct debits. These are all available within our branches, because they help you doing cashless transactions, so that we are able to understand your business. So keep on engaging. I think I want to rush a bit because of time. My call to action, or my request, is keep on engaging our branch managers. They have a limit to they have an approval limit to approve up to 2 million within the branch, or 500 for unsecured, 500,000. Then make use of the payment transactions, payment and collection platforms that are indicated there. We'll share both the presentation for your ease of reference, or visit any of the business any branch across the network, any branch manager, and please engage on all those solutions that we have talked about. Don't also visit, we have a website that will an MSME online portal that we put all this information, and also that will be able to help you get some of this insight, keep abreast on what is happening. And lastly, as I had earlier mentioned, this is our 53rd webinar. We'll continue with this arrangement to ensure that we give you more webinars, so that you keep abreast on what is happening, help you navigate the challenges that are coming on our way, and also help you identify the upcoming opportunities or opportunities that you can leverage on to grow our business. So from a banking perspective, I say we'll continue supporting our MSMEs through our vast branch network. Visit us, let's have a conversation. Use these documents that you'll be sharing to prompt or create an engagement. And again, keep our I want to assure our customers out there, even those who have not joined us as our customer, to continue supporting the MSMEs. So I think, Peter, for the interest of time, I'll hand it over to you so that we can also take some few questions. Thank you.
Thank you very much, Anthony, for your presentation. And I can see we have really overrun on time, but we have done well. So I'd like to thank everyone, and I'd like to thank Peter from your end for all the arrangements to make this one possible. I'd like to thank all our participants. You've stayed with us from the beginning up until now. I'd like to thank also Gideon and Winnie, who have been responding to the questions that we've had in the Q&A section online. So I would like also to thank our presenter, Esther, for such a great presentation. There's so much feedback coming in on the chat box there. So I'd like to bring this one to a close. And for any question that has not been answered, we will share them on email and will be responded back to you. So I'd like to bring this one to a close. And thank you so very much. I'd like to wish each and every one of you all the very best now as we go away. We hope to see you again in the next session. So thank you very much, and goodbye for now.
Thank you. Thank you.
Thank you.
Thank you, Jimmy. Thank you, Esther.
Thank you,
our
bye.
customers.
All right.